Hey everybody, welcome to our webinar. This is Lucena Research, and we're going to talk about our event analyzer. We're going to focus today on sort of a step-by-step sort of how to dig into the details and show you how to take advantage of events in the stock market for investing. A couple disclaimers before we dig in more deeply. First of all, we're not a investment advisor, so we're not giving investment advice. We're going to show you examples of techniques that have worked historically, but there's no guarantee that these will be profitable in the future. And these results are, of course, hypothetical, so keep that in mind before you carry anything forward here. Okay, just one second. I'm the speaker. I'm Tucker Balch, former F-15 pilot. Not that that matters much, but people are often interested to know about that. I'm currently a professor of interactive computing at Georgia Tech, where I teach courses in artificial intelligence and finance. I'm now CTO of Lucena Research, which is the company that's created this really fantastic technology that I'm excited to show you. So overview of this webinar, we're aiming for about 30 minutes. I'm going to try and keep it quick and to the point. Overall, we're going to talk about financial markets and how events affect prices. I'm going to give you a quick overview of our flagship product, QuantDesk, and then I'm going to show you how you can use QuantDesk to discover and exploit events. We're going to look at a couple very specific case studies, and we've got an exciting announcement at the end, so stick it out to the end, and hope you'll be excited by the event that we our announcement at the end. And finally, we'll take questions there at the end. Okay, so QuantDesk is essentially big data for the stock market. We've got a number of tools that are available. It's a cloud-based product that's delivered to your desktop through the internet via web browser. We've got a number of important modules. We've got a machine learning-based forecaster. We also offer portfolio optimization using mean variance optimization. We've got a hedge finder that's unique to us. And what I'm going to be talking about today is this event analyzer. And all of these products are available through the QuantDesk platform. Also, we'll show some examples using our backtester as well, so you can essentially create an event detection strategy within the event analyzer, and then you can backtest how well that would have worked in actual market trading. Now, real quick, let me talk about what is an event, how we can analyze an event, and how we might take advantage of it in investing. This is a study from a classic paper on event studies, and the authors looked at news events, both good news and bad news, and they looked at how those events affected future prices of stocks. So this vertical line here represents the date of the event, and these other lines here represent the change in price of stocks over time. So for stocks for which there was good news, we see that after the event at which the good news occurred, a sharp spike upward in price change, and then price sort of drifts sideways. And this represents an average of what happens across hundreds of stocks and all total thousands of events. So we see reliably here this pattern of when a good news event occurs, upward price movement. And another aspect of this that's kind of interesting is the price tends to drift up even before the good news event. So that might represent leakage of information or whatever. A similar kind of mirror pattern here for negative events. When there's a negative event, we see a sharp downward drop in price. Now, this is an event study, and what's powerful about it is it represents an aggregate of many examples, and it enables us to statistically look at what happens on average, and then we can draw from that how we might take advantage of it in the stock market. Now, a couple things to look at in this example. First is how much does the price change? And in this case, we're seeing a change of about 1%. But then what happens after the event? For instance, negative price events, we see a sort of a gap down and then a drifting back up. So if you were to take advantage of this in a trading strategy, you wouldn't want to, if say you were going to short negative events, you wouldn't want to hold the stocks beyond 2 or 3 days, because after that the advantage is diminished. So keep that in mind as we go forward and look at this in more detail with QuantDesk. Okay, so here are the kinds of questions that we can look at and answer with event studies. One example is what happens to airline stock prices when oil prices drop significantly. We know that oil is a significant component of airlines' operating costs. So what happens if we discover oil prices drop significantly? Does it help airlines out? We can answer questions like that. How do small cap stocks react after they gap up significantly? Do they continue to go up, or do we just see the gap up right when that price changes and we can't really execute on it after that? And then we'll take a look at a more at a technical indicator. We'll look at Bollinger Bands and see if we can leverage Bollinger Bands, for instance, in a trading strategy. Okay, so let's get to the demo. I'm going to exit PowerPoint here and fire up QuantDesk. So here's our platform, QuantDesk. It's delivered through the web, as I said before, and all of the QuantDesk panels are set up similarly. Here you can see the choices of modules across the top. We're focusing today on events and analyzing events. You select which particular strategy or portfolio you want to work with here on the left, and then there's opportunities to configure them down here. One thing that you'll see happening here is on my login, I've got a number of events that I've defined previously, and our system scans continuously to see if any of these criteria have been met, so I can potentially act on them, say at market open, if an event was triggered overnight. We'll talk a little bit more about that later. Okay, so I'm going to build each one of these examples I had talked about from scratch, but some of these things take a fairly significant amount of computing time. So if we end up running into some sort of delay with regard to computing time, I'll skip to the finished result if we need to, because I've already run these scans, and we can, if it takes too long, we can just look at what the result was. Okay, so if we want to create a new study, you just click New Study, and this one will be the one where we look at what happens to airline prices when oil prices drop significantly. So I'll call this oil airline 3. And now the system is ready for me to define the event that I want to look at. So as I said, I want to look at what happens when the price of oil drops significantly. So I have to select from among the many different types of indicators that we have available. This one is a equity event, and we want to look at price drop. And for oil, we'll use USO, which is an ETF that represents, the price of crude oil. So I'll type in USO. So it's asking me here, I just added this criteria. So I'm saying I want to look at drops in US oil, USO. And here I'll define how significant the drop I'm looking for and over what period of time. So let's look at for instance, a 5% drop over 2 weeks. Okay, so I've defined now the event that I want to look at. Now I need to tell the system which equities do I want to examine for the effect of that event. So the white list is the list of equities we want to look at. I'll use Delta Airlines, DAL, and United Airlines. So I've added them to my white list. I'm going to remove S&P 500, but I could, if I wanted to, look at the impact market-wide. Okay, so now we have a fairly simple event defined. It's when the ETF USO drops by 5% or more over 2 weeks, and I want to look at how that affects the price of Delta and United Airlines. One more thing. We need to set the time period over which we want to look at this. So let's look all the way back to from 2010 until now. So we're going to look for this effect all the way since the beginning of 2010. Okay, now we can search for events, and that'll take a few moments. You can see there it discovered 314 events, and it displays them all here. So on January 20th, 2010, there was an event relating to United Airlines. Really, this is an event whereby the price of oil dropped, but we're recording what happened to United Airlines. And as you can see, after 5 days, overall, United went down 1.75%. But over 10 and 15 and 20 days, it ended up increasing in price. And you can see we have hundreds of events here. And you don't want to just look at each necessarily. You don't want to look at each event individually. So you can click this analysis tab and see what happens in aggregate. So here is our event study. This middle line represents the average performance. So every time of all those 314 events, after time 0, this is on average what happens to the price. So what's interesting to notice here is price goes up gradually for about 5 days. We see a mean of 0.64% gain, and then it tends to drift and then actually come down over time. So this is not an extraordinarily exciting event, but it's illustrating the relationship here between oil prices and airline stock prices. Another thing to note is as we approach this event, the stock price is gradually increasing, and that probably represents the fact that folks had been observing that the price of oil was going down, and that was affecting the prices of the stock even before the defined event that dropped 5% over 2 weeks. Now we can operationalize this actually in a strategy using our backtester. So again, this is a very simple sort of event and strategy, and I'm just showing this to you for illustration purposes. We'll get into a slightly more couple interesting events in just a moment. Now here's how we can operationalize it in the context of a backtest. So again, we clicked on backtest. We're doing an event-based backtest, and here we're selecting which event we're going to look at. So again, it's that oil price drops event, and we're going to be looking at Delta and United. Now, when you're configuring a backtest, there's a lot of options, and they're all available here on the left. I'm not going to dwell on them in too much detail. I'll just tell you about them as I fill them in. So we're going to assume we start with $1 million portfolio, and we'll start the backtest again going back to 2010 until the present. We'll use S&P 500 as a benchmark. We can enter transaction costs here. So for instance, we'll assume, just for argument's sake, we need to pay a commission of $1 per trade. There's other factors like slippage and so on. We'll go into more detail on those in a separate conversation. Okay, we're going to do a long-only strategy. We noticed when we were looking at the event that the sort of optimal time to exit was about 5 days, because that's when the price was maximized. So we'll say we'll hold for 5 days. This rank equities is something I'll cover a little bit later. So we'll allow ourselves to hold up to 4 equities, and each time we enter a position, we'll allot 50% of our portfolio to those positions. Okay, so we're all set up now to run the backtest. So this now is going to go back to the beginning of 2010, and it's going to walk forward in time, and each time one of these events occurs, it's going to simulate purchasing either Delta or United. And you can see here there are 157 trading days essentially, and it's marching forward through those. Now I'm not going to wait for this to complete, because as you can see, it may take a few minutes. I can just click on Process in the background, and we can come back and check on it later. Now I've already run this backtest, and so we can go to our job queue and look at the finished result. So this is the one that's running right now, and you can see about what percentage of it is done. But here's one that I had run before, and we can take a look at it. So the orange line here is the performance of this strategy, and if you note here, we start at $1 million back in 2010, and we end up at 1.15 million after a few years. Now these flat areas represent times during which there was no event, and each time we see a little blip here, that's when an event occurred. This latest event here, we made about almost 10% here on that latest event, but there were also events that resulted in loss here. So it's a volatile strategy, but it serves to illustrate how we can go from a hypothesis of oil affecting airline prices to an actual executable strategy. So let's close the book on that one, and now let me show you some other ones that are also interesting. That one was very simple. These next ones are potentially a bit more complex, and will show off the power of our system a little bit more. Okay, so let's take a look at a situation where a small or mid-cap stock has a significant increase in price, perhaps more than the market overall, how does it continue to perform after that event? So let's create a new study. We'll call it small cap up. Now, something I did not mention before, and I'm going to focus on now, is when we looked at that oil and airline example, the back test was conducted it was conducted over the period of time that we had done the initial event study. So that's called an ensample test. And to some extent, it's a little bit of an unfair test because it means that we already know that on average, these events are going to perform positively. So to be more proper, a better way to do things is to go back in time, conduct your event study in an earlier period of time, and then run your back test forward into the future, so you're not really cheating by testing over the same period of time. So let me show you what I mean here. So we're going to configure this small cap experiment. Let's first set the equities that we're going to look at. We'll look at we'll use Russell 1000 and S&P 400 mid cap. So we're gonna look at all the stocks that are in the Russell 1000 and the S&P 400. And I'm going to remove the S&P 500 here. Okay, so that's the set of stocks we're going to be looking at. Now, if you wanted to exclude particular equities, you could use the blacklist function and explicitly list either lists of stocks or individual stocks or ETFs that you didn't want to look at. We won't use that for the moment. Okay, so let's add some definitions of an event. Again, we're going to look at these events. We'll check for a price gain. So we're going to look across our equity universe for a price gain over 1 day of 2% or more. Now that's just the individual stock. Let's also add a condition where the market itself also goes up. And we're looking for situations where the S&P 500 only went up 1%. So we're looking for stocks that went up 2% when the market went up also 1%. And we'll save that. Oh, and we're going to do this, we're going to look from the beginning of this year to May. So we're only going to look from January to May, and then we'll run our back test past that time, and we'll see if whatever results we observe persist. Okay, so we've defined our event, and now we'll look for events. Now I see that there's a few questions, so while things are processing, I'll take a look at a few of the questions. Oh, I see. I see folks are that my colleague Aries is answering some of these questions. I'll come back. I'll still answer the questions when next time we have a little break here. Okay, so we had a lot of events. There were 2,200 events. Let's look at an analysis here of those. So you can see, indeed, there's a nice increase in price, and that price apparently gain continues even out to 20 days. But let's take advantage of some of the power of QuantDesk to hone in on this a little bit and see if we can refine our events a little bit more. Now, this panel over here is really one of the most interesting and powerful tools that QuantDesk offers. And let me show you what you can do here. Uh, you know, as you see, we have the average price, and these upper and lower lines show standard deviations. In other words, you know, we see quite a bit of volatility initially. That's why those upper and lower lines are spread so significantly. And each individual event, you know, is sort of, you can think of as a path through this space. And like I said, there's 2,200 of those. What if we just want to? What if we want to see if we can use some of our factors to isolate some of them? So what I've done here is said, okay, I want to focus on those stocks and events that perform from on average to a significant gain. And that's symbolized here by the orange area. And what QuantDesk does for me is it looks through all of the 300 factors that we have, and it lists those factors that that help separate most effectively the stocks that ended up in this yellow area from the ones that ended up down there. So we can say, yeah, okay, that indicator, days since the MACD buy cross. So this is a fairly, it's all the details of that particular indicator. That one helped most effectively to separate the stocks that ended up here from the stocks that ended up down here. And one other factor we can set up here is to say, okay, over which period of time do we want to make that examination? So let's do it over 20 days instead of 5 days. So it'll take a few moments. Now, why that? Oh, it came back faster than I thought. Okay, so when we do that, actually, you see that it suggests a different indicator because we're looking at where the stocks end up out here instead of earlier we were looking at where they were here. So let's accept. Okay, we'll say okay, use the Arun indicator now to help to further define the event. So we'll add that to the event definition, and now it'll run it again. And it'll what it's going to do is it added to the definition of the event the Arun indicator, and it used the thresholds for Arun that most effectively separated the stocks that ended up higher than the ones that ended up lower. You can see we have a much smaller number of events. You can also see that our standard deviation is decreasing, which means it's a little bit more of a stable approach. And we're looking at a gain over these 20 days of about 2.8%. Now, you've been seeing these heat maps up here. I haven't commented on those yet. Let me comment on those now. We've got each of the major sectors of the market identified here, and even subsectors. Let me, for instance, we can, I clicked on industrials, and we can drill down into industrials. So there were 187 events within industrials, and you can see that we're serving to further refine our search here. Now they're colored green if they went up in price, and red if they went down in price. And there's two ways you can look at the heat map. You can look at them; they can be scaled by how frequent there were events, or you can scale them by market cap. So, for instance, I don't know which stock this is, but obviously it's got a very large market cap. But scaling it that way doesn't really reflect the opportunity for investment. So scaling by frequency of events is a little bit better. We can, let's go back to the overall market here. Now we can take advantage of QuantDesk sort of in the same way we allowed it to look for indicators that could further refine our event. So we're back now at the 1200 events. We can ask QuantDesk to search over all the sectors and subsectors for those sectors that responded most positively to this event. So in the same way that we can take advantage of finding indicators down here, we can drill down and look for sectors here. So let's ask it to refine our event to look only at those sectors and subsectors that gained at least 1% after the event. So we'll update that. Now each time we do this, we end up reducing the total number of available events because we're adding more and more constraints. So we're saying now, okay, we only want to look at these particular subsectors when both they go up at least 2% and the market goes up 2%, and we have these other technical indicator constraints. But you can see each time we do this, although yes, we reduce the total number of events, we're discovering more and more profitable events. So now we're looking at a gain of as much as 5% now over these 20 days. Now again, this is we're kind of data mining here, and we're looking for positive results over this time period from January to May. So we know that we're going to see positive results because that's what we're asking the system to look at. But through the backtest, we can continue forward in time and see if they continue to be profitable after this time period. And that's an important aspect. So let's do that now. Let's now take a look at a backtest. We'll do an event-based backtest, and we're going to use the small cap up event. So this here is the definition of our event. Our whitelist is Russell 1000 and S&P 400, and we're looking for a price gain of the individual equity 2% and the S&P 500 of 1%. And furthermore, we're looking for values for the particular stock of the Arun down indicator between 11 and 94. And that was discovered for us automatically through the system. And here we further refine things. You can see, for example, the system discovered that construction materials and containers and packaging were especially responsive. So that's the result of the study looking at the sectors and subsectors. Okay, so that's the definition of our event. Now we're going to backtest it. Again, we'll start with $1 million. And we'll do it year to date. So our backtest now is going to go from the beginning of the year through May, which is the period we conducted the study, but then from May all the way up till now. Will be long only, and this is the method by which we can rank which equities to select. I'll have to cover that later. Now, if you recall, the return peaked at 20 days, so we're going to hold for 20 days, and we'll allow ourselves, let's say, to hold as many as 20 equities, and each one will put 10% of our funds in. And we'll start that back test. Now let me answer one or two questions while we're waiting on that. So first question is, nice hair. Well, thanks for that comment. Next question is QuantDesk a software? Yes, it is. It's a cloud-based software delivered through through your browser, just like I'm showing you right here. A question about crude oil futures. Presently, we don't have futures prices, but that's definitely on our horizon. We currently cover ETFs, stocks, ADRs, and mutual funds. Okay, let's look at the results of this backtest. So, nice results. So again, the result of our strategy is illustrated here in the orange line, and the market is represented by the blue line. Now you might say, gee, the market ended up over this time period a couple percent above our strategy. Isn't the market better? Well, yes, in terms of total return, but in terms of volatility, this strategy that we had created actually is much, much less volatile. In fact, there's periods here where it wasn't even trading. Another thing to point out that's very important is the area over which, the time period over which we had conducted our study is here, January through May. So we expect, we should absolutely see good performance here, because that's the area over which we were data mining. But after May, we're continuing with the factors we had discovered in this earlier period. And so from here to here, that's a legitimate forward test, and the performance we're seeing here is not the result of in sample. It's this part is out of sample. So we've got a nice Sharpe ratio, nice performance statistics overall. Now, one thing to observe here is exposure here. That shows how much of our funds that we had invested. You can see the amount is fairly low. For instance, with $1 million here, it looks like we're invested about 20%, meaning that only 200,000 were invested there, and that's because there weren't enough events occurring during this period. We eventually reached full exposure here, meaning that there were enough events and we allocated enough to each event. Now we can change this and be more invested in the market, say by, instead of allocating only 10% to each opportunity, we could bump that up, say, to 20%. And I'll fire that off and let that run while we look at we'll look at one more example. It looks like this one is going to finish quickly, so we'll take a look at it. Okay, so you can see our exposure now is closer to 50% earlier on. And let's look at how that affects our performance overall. Well, you can see, because essentially we're investing more of our funds in a strategy that was working well, we end up outperforming the market even more significantly. Again, strong Sharpe ratio and so on. Okay, so I think that I've shown some good examples here. Let me show you one more feature of our system before I continue with the rest of the presentation here. We offer a very detailed backtest report. I just wanted to show you here. It repeats, of course, that chart showing performance, but provides much more detailed information, including what I want to show you down here are the actual trades. So if you wonder, okay, what did this system actually suggest to do, you can go back through time and see what the transactions were on each day there was trading. Okay, let me get back to the presentation as we were moving along there. And the important thing I wanted to get to is the announcement, and that is we're offering for up to 100 customers a significantly discounted offering where we'll offer the Event Analyzer that I just showed you along with our backtester for only $250 a month. Now, we announced this also about a month ago, and we've had a number of customers take advantage of that. There are a few slots left, so if you'd like to try this out, now is a great time. And if you do want to try that just send us an email to sales at Lucena Research. If you want to give it a try, you can go to our website, lucenaresearch.com, and just click on the big orange button. We're also available on Bloomberg. The event analyzer that I just showed you isn't yet fully available on Bloomberg, but it will be deployed there soon. Okay, so I see that we have a few questions, so let me answer those really quick. The next question was, can you do this on ETFs as opposed to stock? And the answer is absolutely yes. In the case of ETFs, however, we don't have available, for instance, fundamental indicators, but we've got all the technical indicators available, and so you can indeed use ETFs. For instance, in the oil and airlines example, we use the ETF USO. Final question here, does QuantDesk support intraday frequency, in other words, minutes? And the answer is currently no, but we are right now working very hard on adding intraday capability. In fact, that's going to be our next big important rollout, is the capability for you to define events and for the system to scan intraday for particular values and deliver to you a message when those criteria are met. So we're real excited about that. That'll be coming out soon. Okay. We thank you very much for your time. We've been going for 46 minutes, and I hope you found this presentation valuable. If you have any questions, please send them to us. Just send an email to info@lucenaresearch.com, and we'll be glad to get back to you. Again, I'm Tucker Balch, and we are Lucena Research here in Atlanta, Georgia. Thanks very much for your time.